Welcome, crypto enthusiasts. I'm your loyal and stylish host, bringing you the latest and greatest from the wild world of crypto right here on DogBlock News, where the news doesn't just bark, it bites. The birth of Bitcoin and the innovation it introduced in 2008, a groundbreaking white paper was published that would forever change the financial landscape. The title was Bitcoin, a peer-to-peer electronic cash system, written by an anonymous figure known only as Satoshi Nakamoto. This paper introduced the world to the concept of a decentralized digital currency and marked the beginning of Bitcoin's journey as the first ever cryptocurrency. Bitcoin's innovative nature would go on to shape the financial system and blockchain technology for years to come. The concept of digital money. What set Bitcoin apart from traditional currencies was its decentralized nature. Unlike conventional money, which is issued and regulated by governments or central banks, Bitcoin operates without a central authority. Before Bitcoin, there were various attempts to create digital cash systems, but they all relied on centralized intermediaries such as banks. These systems were plagued by issues like government control, high transaction fees, and slow processing times. There was also a lack of trust, as users had to depend on third parties to verify transactions. Bitcoin, however, offered a novel solution to these problems. It proposed a peer-to-peer system that allowed people to send and receive payments directly without relying on banks or any intermediary. This peer-to-peer transaction model was powered by blockchain technology, which ensured transparency, security, and immutability. The role of blockchain technology. At the heart of Bitcoin's innovation was blockchain technology. Blockchain is a decentralized, distributed ledger that records all transactions made with Bitcoin. Each transaction is stored in a block, which is then linked to the previous block, forming a chain. This chain of blocks is maintained by a network of computers nodes around the world, each verifying and recording transactions. Once a transaction is confirmed, it cannot be altered or deleted, making it nearly impossible to counterfeit or manipulate the system. This decentralized structure meant that Bitcoin did not need a central authority, such as a bank, to validate transactions. Instead, the network itself ensured that all transactions were legitimate, creating an unprecedented level of trust in the system. Additionally, Bitcoin's transparent ledger allowed anyone to view the entire transaction history, providing full transparency without compromising user privacy. The initial struggles and adoption. When Bitcoin was first introduced, it faced a lot of skepticism. The idea of a digital currency with no central authority seemed strange, and many doubted whether it could ever gain traction. In its early years, Bitcoin had very little value, and the first few transactions were mostly between a small group of early adopters. In fact, the first ever real-world transaction using Bitcoin was in 2010, when a programmer named Laszlo Hanyecz paid 10,000 BTC for 2 pizzas, an amount that would be worth millions of dollars today. Despite this humble beginning, Bitcoin's popularity gradually grew. As more people learned about the technology and the potential benefits of a decentralized currency, the number of users started to rise. Bitcoin began to be used for more practical purposes, such as transferring funds across borders with low fees and providing an alternative payment method for people in countries with unstable economies. The first mining reward in Bitcoin's growth. Bitcoin's mining process was also revolutionary. Miners use computational power to solve complex mathematical puzzles, validating transactions and securing the network. In return for their efforts, they were rewarded with newly minted Bitcoin. The first block ever mined by Satoshi Nakamoto, known as the Genesis block, included a reward of 50 BTC. As more blocks were mined, the reward decreased over time, following a predictable halving process that would ensure the total supply of Bitcoin never exceeds 21 million coins. Bitcoin's price remained relatively low in its early years, but the increasing demand and adoption led to periodic spikes in value. By 2011, Bitcoin reached the $1 mark for the first time, and by 2013, it hit $266. These milestones helped to cement Bitcoin's place in the cryptocurrency world, and its price continued to rise as more people discovered its potential. The growing network and early challenges. Despite the growing popularity, Bitcoin was not without its challenges. Its decentralized nature meant that there was no single entity to protect it from malicious attacks or hacking attempts. Bitcoin exchanges, which served as platforms for buying and selling Bitcoin, were targeted by hackers in the early years. One of the most significant incidents occurred in 2014 when Mt. Gox, one of the largest Bitcoin exchanges at the time, was hacked, resulting in the loss of around 850,000 BTC. This event highlighted the risks associated with using Bitcoin and the importance of securing both the network and exchanges. However, these challenges did not stop Bitcoin from growing. Over time, the technology surrounding Bitcoin evolved, and solutions were developed to address security vulnerabilities. New wallets, exchanges, and payment processors emerged, making it easier for people to use and store Bitcoin safely. Bitcoin's impact on the financial world. Bitcoin's success laid the foundation for the creation of thousands of other cryptocurrencies, often referred to as altcoins. However, Bitcoin remained the dominant player in the market, continuing to drive innovation and inspire new technologies. As the years passed, Bitcoin became more widely accepted by merchants, financial institutions, and even governments. It was increasingly seen not just as a currency, but as a store of value, often referred to as digital gold. Bitcoin's ability to operate outside the traditional financial system appealed to a broad range of people, from those seeking privacy to those living in countries with unstable currencies. It was also seen as a hedge against inflation and economic uncertainty, which drove its increasing adoption by institutional investors. Bitcoin's birth in 2009 marked the beginning of a financial revolution that would go on to shape the future of money. By introducing blockchain technology and creating a decentralized currency, Bitcoin solved many of the problems associated with traditional finance. Despite facing challenges and skepticism in its early years, Bitcoin has grown to become the most recognized cryptocurrency in the world, with a market value in the hundreds of billions of dollars. Its success has led to the development of thousands of other cryptocurrencies, and its influence continues to expand, shaping the future of global finance. The emergence of altcoins. How competition and innovation developed in the crypto space. After Bitcoin's inception in 2009, it became the pioneering cryptocurrency, demonstrating the power of decentralized money and blockchain technology. However, as Bitcoin grew in popularity and its blockchain became more well-known, many saw the potential for improvement and innovation in the cryptocurrency ecosystem. These early pioneers created what became known as altcoins, alternative cryptocurrencies to Bitcoin. The term altcoin generally refers to any cryptocurrency that is not Bitcoin. It is a combination of alternative and coin. The altcoin revolution began shortly after Bitcoin's early successes, with the first altcoins emerging as attempts to address some of Bitcoin's limitations, expand on its capabilities, and bring new ideas to the blockchain ecosystem. The first significant altcoins were launched in the early 2000s and set the stage for a period of rapid competition, experimentation, and innovation within the cryptocurrency space. Litecoin, the first major altcoin. In 2011, Litecoin, LTC, was created by Charlie Lee, a former Google engineer. Litecoin was inspired by Bitcoin, but it sought to improve on some of its limitations. While Bitcoin's blockchain used a proof-of-work (POW) consensus mechanism, Litecoin introduced a few key differences that would appeal to users looking for faster transaction times and lower transaction fees. Litecoin's primary innovation was its faster block generation time. Bitcoin's blockchain generates a new block approximately every 10 minutes, while Litecoin reduced this time to around 2.5 minutes, making transactions faster and more efficient. This made Litecoin a more appealing option for microtransactions, where users needed fast, low-cost transfers. Despite the similarities to Bitcoin, Litecoin introduced the idea of improving upon existing systems by providing an alternative that could better serve specific use cases. This concept of building on Bitcoin's foundational ideas became a core theme of altcoins that followed. Ripple, XRP, bridging traditional finance and cryptocurrency. In 2012, Ripple, XRP, entered the scene with a unique proposition to integrate cryptocurrency with traditional financial systems. Ripple was not just a digital currency, it was a comprehensive payments platform designed to facilitate fast, low-cost cross-border transactions. Ripple's key innovation was its focus on enabling financial institutions to send money across borders in a secure, near-instant manner. Unlike Bitcoin or Litecoin, which operated on decentralized, permissionless blockchains, Ripple was built with a more centralized model in mind. Its consensus algorithm, known as the RippleNet, was designed to work with pre-established financial networks rather than creating an entirely new decentralized ecosystem. Ripple's goal was to enhance the traditional banking system, not disrupt it. While Ripple has faced significant regulatory scrutiny, especially from the U.S. Securities and Exchange Commission, which filed a lawsuit against the company in 2020, the project has nonetheless demonstrated the potential for blockchain to serve as a bridge between traditional finance and the crypto world. Ethereum, smart contracts, and decentralized applications. Perhaps the most significant development in the altcoin space came in 2015 with the launch of Ethereum. Created by Vitalik Buterin, Ethereum was a revolutionary departure from Bitcoin and other altcoins. Instead of simply serving as a digital currency, Ethereum introduced the concept of smart contracts, which allowed developers to create decentralized applications, dApps, on its blockchain. Ethereum's blockchain allowed developers to program custom applications that could run without intermediaries, opening the door for a new world of decentralized finance, DeFi, decentralized exchanges, DEXs, and more. This innovation catalyzed the growth of blockchain applications that extended far beyond what Bitcoin had initially intended. Smart contracts on Ethereum were designed to automatically execute agreements based on predefined conditions, making them tamper-proof and reducing the need for third parties. This marked a massive leap forward in blockchain technology and set the stage for the rise of an entirely new ecosystem, known as DeFi, in which users could interact with financial services without relying on banks, brokers, or traditional financial institutions. Ethereum's success inspired countless other projects to explore smart contract functionality and alternative consensus mechanisms. Ethereum remains one of the most important cryptocurrencies in the world, continuing to drive innovation in the blockchain space. The rise of other altcoins, diversity and experimentation. With Bitcoin and Ethereum leading the way, the cryptocurrency market quickly became saturated with new altcoins, each vying for attention and innovation. Over the years, countless altcoins have emerged, each offering unique features, use cases, and blockchain solutions. Some notable altcoins include Dash, formerly Darkcoin. Dash was created in 2014 by Evan Duffield and focused on faster transaction speeds and improved privacy. Dash introduced a feature called Private Send, which allowed for enhanced anonymity in transactions. Monero, XMR. Launched in 2014, Monero focused on privacy and fungibility. It utilized a unique cryptographic technique called ring signatures, making it one of the most privacy-centric coins in the space. Monero's focus on anonymity made it a favorite among users who prioritize privacy over transparency. Bitcoin Cash, BCH. Bitcoin Cash was created in 2017 as a result of a contentious hard fork from Bitcoin. The developers behind Bitcoin Cash believed that Bitcoin's scalability issues were holding the network back, so they increased the block size limit to allow for more transactions to be processed at once. Cardano, ADA. Launched by Ethereum co-founder Charles Hoskinson, Cardano is a blockchain platform that aims to provide a more secure and scalable infrastructure for the development of decentralized applications. Cardano uses a proof-of-stake, EPOS, consensus mechanism, which is more energy efficient than Bitcoin's proof-of-work, POW. Polkadot, DOT. Created by Ethereum co-founder Gavin Wood, Polkadot is a multi-chain platform that allows different blockchains to interoperate with one another. Polkadot's vision is to create a decentralized web where blockchains can communicate and share data seamlessly. Competition and innovation. A continuous evolution. As the altcoin market grew, so did the competition. Each altcoin sought to offer something unique, whether it was enhanced security, faster transactions, better scalability, or the ability to run decentralized applications. This constant innovation and experimentation led to a rapid pace of development in the cryptocurrency space. The rise of decentralized finance, DeFi, for example, spurred the creation of decentralized exchanges, lending platforms, stablecoins, and yield farming protocols. Altcoins that provided unique functionalities within this ecosystem, such as Uniswap, AV, and Compound, saw massive growth in 2020 and 2021. One of the defining features of the altcoin market is its ability to experiment and explore new use cases for blockchain technology. While Bitcoin remains the leader in terms of brand recognition and market capitalization, altcoins have proven to be a crucial driver of innovation, offering new solutions and expanding the potential of blockchain beyond digital currency. The future of altcoins and competition. The altcoin ecosystem is constantly evolving, driven by a desire to innovate and improve upon Bitcoin's original design. Each new altcoin represents a chance to tackle new problems, enhance scalability, improve privacy, and offer decentralized financial services that could revolutionize the traditional financial system. As blockchain technology continues to mature, we can expect even more competition and innovation in the altcoin space, with new projects emerging to solve specific problems and address the challenges of existing systems. Altcoins will continue to be an essential part of the cryptocurrency landscape, driving the industry forward and offering users a diverse range of options and opportunities. Technological evolution, the transformation of networks and protocols, from Bitcoin to Ethereum. The rise of blockchain technology, driven by Bitcoin's introduction in 2009, marked the beginning of a new digital era. Bitcoin's creation was revolutionary because it introduced the idea of decentralized peer-to-peer transactions without the need for intermediaries. However, while Bitcoin was groundbreaking, it also had its limitations, particularly in its use case as a purely digital currency. Over time, the blockchain community sought to improve and expand upon Bitcoin's foundational ideas, ultimately leading to the creation of Ethereum and its significant advancements in blockchain technology. Bitcoin, the first blockchain and its limitations. Bitcoin, created by the pseudonymous Satoshi Nakamoto, is based on a blockchain that serves primarily as a ledger for financial transactions. Its most significant innovation was the use of proof of work, POW, which secures the network by requiring miners to solve complex mathematical problems to validate and add transactions to the blockchain. However, Bitcoin's blockchain was designed with a specific focus on being a digital currency, and this single-purpose architecture imposed constraints on its scalability and functionality. Bitcoin's block size limit and block time, approximately 10 minutes, resulted in slower transaction processing speeds compared to traditional financial systems like Visa or PayPal. As Bitcoin grew in popularity, the issue of scalability became more evident. Transactions became slower, and the cost of transactions increased due to network congestion. This led to debates within the community, culminating in the Bitcoin block size debate in 2017, which resulted in the creation of Bitcoin Cash, BCH. While Bitcoin's blockchain was a monumental achievement, it lacked the ability to execute complex applications or smart contracts, limiting its potential to revolutionize other industries. It was clear that a more versatile and adaptable blockchain was needed, one that could go beyond just financial transactions and lay the foundation for more complex applications. This need for a more flexible blockchain led to the creation of Ethereum. Ethereum, a new paradigm with smart contracts. Ethereum was proposed by Vitalik Buterin in late 2013 and launched in 2015. Ethereum introduced several key innovations that were absent in Bitcoin's design, most notably the concept of smart contracts. A smart contract is a self-executing contract with the terms of the agreement directly written into code. Smart contracts are decentralized, meaning they run on Ethereum's blockchain without the need for intermediaries. This innovation allowed for the creation of decentralized applications dApps, which could run autonomously based on the logic embedded within the contracts. Ethereum's introduction of Turing-complete programming meant that developers could write code capable of performing a wide range of functions, not just transactions. This was a breakthrough because it allowed for the development of financial systems, such as decentralized finance or DeFi, non-fungible tokens, NFTs, gaming, supply chain management, and much more, all within a decentralized ecosystem. Ethereum used a similar proof-of-work (POW) consensus mechanism, like Bitcoin initially, but its ability to execute more complex applications set it apart. However, Ethereum also faced scalability issues, as its network became congested due to the growing popularity of its dApps. This limitation led to the search for a more scalable and efficient consensus mechanism. Ethereum's technological innovations. Moving beyond proof of work, while Ethereum introduced a significant leap forward in blockchain technology, it also encountered the same scalability challenges that Bitcoin faced. Transactions on Ethereum became slower, and gas fees, the cost of executing transactions in smart contracts, increased as the network became more congested. These issues were particularly evident during times of high demand, such as during the rise of DeFi protocols in 2020. To address these challenges, Ethereum has undergone a technological evolution through several key updates, notably its transition to Ethereum 2.0, which aims to replace the proof-of-work mechanism with proof-of-stake. Proof-of-stake, a greener and more scalable consensus mechanism. The transition from proof-of-work to proof-of-stake is one of the most significant upgrades to Ethereum's network. In POW, miners compete to solve complex mathematical problems, which requires vast amounts of computational power and electricity. Ethereum 2.0 aims to address this inefficiency by using proof-of-stake, where validators are selected to create new blocks based on the amount of cryptocurrency they hold and are willing to stake as collateral. POS is considered more energy efficient than POW because it doesn't rely on intensive computational work to secure the network. In POS, validators are chosen randomly, and they validate transactions based on the amount of Ethereum they hold and are willing to lock up as collateral. This method of consensus requires less energy, making it more sustainable and scalable. Additionally, Ethereum 2.0 introduces sharding, a technique that splits the blockchain into smaller pieces or shards, allowing multiple transactions to be processed in parallel. This dramatically increases the network's capacity to handle more transactions and dApp activity, further improving scalability. Layer 2 solutions scaling Ethereum without changing the core protocol. As Ethereum works toward the full implementation of Ethereum 2.0, Layer 2 solutions have emerged as a way to scale the network without altering the core protocol. Layer 2 solutions are built on top of the Ethereum blockchain and provide a way to execute transactions more efficiently, reducing the strain on the main Ethereum chain. Examples of popular Layer 2 solutions include optimistic rollups. These are solutions that batch transactions off-chain and only submit finality data to the Ethereum mainnet, reducing the amount of data that needs to be processed on-chain. ZK rollups. These use zero-knowledge proofs to bundle multiple transactions into a single one, improving scalability and transaction throughput while ensuring privacy and security. These Layer 2 solutions are designed to alleviate the congestion on Ethereum's mainnet, enabling it to scale without compromising its security or decentralization. As Ethereum continues to grow, Layer 2 solutions will play a critical role in ensuring that the network can handle the increasing demand for dApps and smart contracts. Other blockchain protocols competing with Ethereum's dominance. As Ethereum continues to evolve, other blockchain protocols have emerged to compete with its dominance, each offering unique features and advancements in blockchain technology. Some of the most notable competitors include Binance Smart Chain, BSC, created by the Binance Exchange. BSC is designed to provide fast, low-cost transactions and smart contract functionality. It is compatible with Ethereum's dApps but offers significantly lower gas fees and faster block times. Solana. Solana is a high-performance blockchain that aims to provide scalability, low fees, and fast transactions. It uses a unique consensus mechanism called proof of history, POH, which allows it to process thousands of transactions per second. Polkadot. Developed by Ethereum co-founder Gavin Wood, Polkadot is designed to enable the interconnection of multiple blockchains. Polkadot aims to create a multi-chain ecosystem where different blockchains can communicate and share information. The future, Ethereum and the continued technological evolution. As Ethereum works toward full implementation of Ethereum 2.0, the blockchain space will continue to see rapid technological advancements. The shift to POS, the implementation of sharding, and the rise of Layer 2 solutions will all contribute to making Ethereum a more scalable, efficient, and sustainable blockchain. In addition, the continued development of other blockchain protocols will drive further competition and innovation. The success of Ethereum's upgrade will have far-reaching effects on the future of blockchain technology, influencing other networks as they adapt to new consensus mechanisms and scaling solutions. Major jumps in the market. How cryptocurrency prices were affected in the emergence of massive projects. The cryptocurrency market has been characterized by extreme volatility, with the prices of digital assets often experiencing significant jumps, both upwards and downwards. These price fluctuations are influenced by a variety of factors, including market sentiment, regulatory news, technological advancements, and the emergence of new projects. The rapid growth of cryptocurrencies has been accompanied by a boom in decentralized finance, DeFi, non-fungible tokens, NFTs, and innovative blockchain projects that are pushing the boundaries of what blockchain technology can do. In this article, we will explore some of the major jumps in the cryptocurrency market, their underlying causes, and the emergence of massive projects that have reshaped the space. The early days. Bitcoin's first bull run. The cryptocurrency market first gained attention in the early 2000s with Bitcoin, BTC, the first decentralized cryptocurrency. Initially, Bitcoin was viewed with skepticism, and its price remained relatively low. However, the market began to take notice in 2013 when Bitcoin's price surged from around $13 to over $1,100 in a matter of months. This sudden rise attracted both retail and institutional investors, marking the beginning of Bitcoin's recognition as a legitimate asset class. Several factors contributed to this early price surge, including growing interest from tech enthusiasts and investors, the increase in Bitcoin adoption as a store of value, and the excitement surrounding its decentralized nature. The rise of Bitcoin during this period created the foundation for the broader cryptocurrency market, and its success encouraged the development of other cryptocurrencies and blockchain-based projects. 2017, the ICO boom and Ethereum's rise. The next major jump in the cryptocurrency market came in 2017. During this year, the market witnessed a massive boom in the prices of many cryptocurrencies, most notably Bitcoin and Ethereum, ETH. Bitcoin's price surged to nearly $20,000 by December 2017, while Ethereum's price increased from $8 to over $700 in the same period. One of the key factors behind this growth was the rise of initial coin offerings, ICOs. ICOs allowed blockchain startups to raise capital by issuing new tokens in exchange for Bitcoin or Ethereum. This innovative fundraising method attracted a great deal of attention, as investors sought to get in on the ground floor of the next big blockchain project. ICOs became a craze, with hundreds of new projects launching in 2017, many of which promised to revolutionize various industries, from finance to healthcare. While the ICO boom created massive price jumps for many cryptocurrencies, it also led to an influx of scam projects and unsustainable ventures. As a result, regulators began to take notice, and ICOs became increasingly scrutinized. Despite the regulatory challenges, the ICO boom of 2017 marked a pivotal moment in the history of cryptocurrency as it demonstrated the potential of blockchain technology to disrupt traditional industries. 2020 to 2021, DeFi and NFTs drive the next major surge. The next significant market jump occurred between 2020 and 2021, driven by the rapid rise of decentralized finance, DeFi, and non-fungible tokens, NFTs. These two trends mark the next phase of innovation in the blockchain space, bringing attention from both retail and institutional investors. DeFi refers to a set of financial services, such as lending, borrowing, and trading, that are built on blockchain networks, particularly Ethereum. Unlike traditional financial systems, DeFi operates without intermediaries like banks, relying instead on smart contracts to automate processes. The growth of DeFi projects such as Uniswap, Reshaped, and Compound led to the rise of the DeFi summer in 2020, during which the total value locked, TVL, and DeFi protocols exploded, pushing the price of Ethereum to new highs. Meanwhile, NFTs, which are unique digital assets stored on the blockchain, gained massive popularity in 2021. NFTs allowed artists, musicians, and creators to tokenize their work and sell it directly to buyers, cutting out traditional intermediaries like galleries or record labels. The NFT market saw a meteoric rise, with some digital artwork selling for millions of dollars. Projects like CryptoPunks, Bored Ape Yacht Club, and Decentraland were among the most popular, attracting mainstream attention from celebrities, artists, and investors alike. This surge in DeFi and NFT activity created a perfect storm for the cryptocurrency market. Ethereum, the blockchain that underpins most DeFi projects and NFTs, saw its price soar, reaching an all-time high of over $4,800 in November 2021. Other cryptocurrencies, such as Solana, Binance Coin, and Polkadot, also experienced significant price jumps as investors flocked to the growing blockchain ecosystem. The rise of Layer 2 solutions and new blockchain networks. While Ethereum was the dominant blockchain for DeFi and NFTs, it faced significant scalability issues. High gas fees and slow transaction times made the network less efficient, particularly during times of high demand. To address these issues, developers turned to Layer 2 solutions and alternative blockchain networks that could offer faster, cheaper transactions. Layer 2 solutions, such as optimistic rollups and ZK rollups, allow for off-chain transaction processing, reducing the strain on the Ethereum network. These solutions enable Ethereum to scale while maintaining its security and decentralization. As these Layer 2 solutions gained traction, Ethereum's ecosystem continued to grow, further driving up its price. Meanwhile, other blockchain networks, such as Solana and Avalanche, emerged as competitors to Ethereum. These networks focused on providing fast and low-cost transactions, making them attractive for DeFi and NFT projects. Solana, in particular, gained significant attention in 2021, with its fast transaction speeds and low fees, making it a popular choice for developers. The rise of Layer 2 solutions and alternative blockchain networks demonstrated that the cryptocurrency space was evolving to meet the demands of scalability and efficiency. This shift created new opportunities for innovation and investment, further fueling the growth of the market. The impact of institutional investment. In addition to the technological innovations and new projects driving the cryptocurrency market, institutional investment played a key role in the market's growth. In 2020 and 2021, several high-profile institutional investors, including MicroStrategy, Tesla, and Grayscale, made significant investments in Bitcoin and other cryptocurrencies. These investments brought legitimacy to the market and helped to further boost prices. MicroStrategy, a business intelligence firm led by Michael Saylor, became one of the largest institutional holders of Bitcoin, purchasing over $1 billion worth of the cryptocurrency in 2020 and 2021. Tesla, led by Elon Musk, also made headlines when it announced that it had bought $1.5 billion in Bitcoin. These moves helped to shift public perception of Bitcoin from a speculative asset to a legitimate store of value. The influx of institutional capital into the market helped drive the price of Bitcoin and other cryptocurrencies to new all-time highs, with Bitcoin reaching nearly $70,000 in November 2021. This institutional involvement also paved the way for the launch of Bitcoin ETFs, exchange-traded funds, which provided retail investors with easier access to Bitcoin exposure through traditional financial markets. The future, new projects, and the continued growth of cryptocurrency. As the cryptocurrency market continues to grow, new projects and innovations are likely to drive future price surges and market jumps. The emergence of central bank digital currencies, CBDCs, privacy-focused cryptocurrencies, and interoperable blockchain networks are just a few of the developments that could shape the future of the space. The evolution of DeFi, NFTs, and other blockchain-based applications will continue to attract both investors and developers, fueling innovation and market growth. As blockchain technology becomes more mainstream, the cryptocurrency market will likely experience further volatility, with prices jumping based on technological advancements, market sentiment, and the emergence of new projects. In conclusion, the cryptocurrency market has seen significant jumps in prices and the emergence of massive projects over the years. These jumps are driven by technological innovation, new use cases, and the involvement of institutional investors. As the market continues to mature, the next wave of cryptocurrency projects is likely to reshape the industry, creating new opportunities for investors and entrepreneurs alike. Challenges in cryptocurrency. Issues like extreme volatility, cyber attacks, and regulatory uncertainty. The cryptocurrency market has grown rapidly over the past decade, becoming an integral part of the global financial system. While the rise of digital assets has brought significant opportunities for innovation, wealth creation, and decentralization, it has also introduced numerous challenges. These challenges are not only technical in nature, but also involve economic, regulatory, and security issues that continue to affect the industry. Some of the most pressing challenges in cryptocurrency include extreme price volatility, cybersecurity threats, and the uncertainty surrounding regulation. 1. Extreme volatility. One of the most well-known characteristics of the cryptocurrency market is its extreme volatility. Cryptocurrencies like Bitcoin, Ethereum, and others have seen their prices surge dramatically in short periods, only to plummet just as quickly. This volatility can be exciting for investors seeking to make quick profits, but it also poses significant risks. The extreme price fluctuations are often driven by a combination of factors, including market sentiment, news, and speculation. When positive news emerges, such as the adoption of cryptocurrency by major companies or institutional investors, prices can rise sharply. Conversely, negative news, such as regulatory crackdowns or security breaches, can lead to rapid sell-offs and price declines. For example, Bitcoin's price has experienced multiple major booms and busts since its creation in 2009. From trading at just a few cents in its early days, Bitcoin reached nearly $20,000 in December 2017, before crashing back down to around $3,000 a year later. Similarly, the price of Bitcoin and other altcoins experienced significant gains in 2020 and 2021, followed by a correction in mid-2021. This unpredictable price behavior makes cryptocurrencies a high-risk investment, which is why many institutional investors remain cautious about entering the market. 2. Cybersecurity threats and hacking. As cryptocurrencies are digital assets, they are particularly vulnerable to cyber threats. Blockchain networks themselves are considered secure due to their decentralized and cryptographic nature. However, the surrounding infrastructure, such as exchanges, wallets, and platforms that facilitate trading, is often targeted by hackers. Over the years, there have been numerous high-profile cyber attacks on cryptocurrency exchanges and wallets. One of the most infamous incidents occurred in 2014 when the Japanese exchange MTGOX was hacked, resulting in the loss of 850,000 bitcoins, worth over $450 million at the time. This event shook the entire cryptocurrency industry and raised serious concerns about the security of centralized exchanges. Another example is the 2020 hack of KuCoin, a major cryptocurrency exchange, which saw over $200 million worth of assets stolen. In both cases, hackers exploited vulnerabilities in the platform's security measures, emphasizing the importance of securing users' funds and personal information. Phishing attacks, malware, and social engineering tactics are also commonly used to trick individuals into giving away their private keys or access to their wallets. Since cryptocurrencies are largely unregulated and transactions are irreversible, recovering stolen funds can be extremely difficult, if not impossible. The risk of cyber attacks continues to grow as the cryptocurrency market expands. Hackers have become increasingly sophisticated, and the rise of decentralized finance, DeFi platforms, has introduced new security challenges. DeFi protocols are often developed with fewer security measures, making them vulnerable to exploits. To address these issues, the industry has made strides in developing better security protocols, such as multi-signature wallets and hardware wallets, which provide additional layers of protection for users. However, as long as the cryptocurrency market remains a target for cybercriminals, security will remain one of the most significant challenges. 3. Regulatory uncertainty. Regulatory uncertainty is one of the most significant hurdles for the cryptocurrency industry. Governments around the world have taken varying approaches to regulating digital assets, and the lack of clear, consistent regulations creates confusion and risk for investors, developers, and businesses in the space. Some countries, such as Japan and Switzerland, have adopted relatively crypto-friendly regulations, recognizing cryptocurrencies as legal assets and implementing clear guidelines for their use. However, many other countries have been slower to establish regulations, leading to uncertainty and hesitation among investors and companies. The United States, for example, has been grappling with how to classify and regulate cryptocurrencies. The Securities and Exchange Commission, SEC, has stated that some cryptocurrencies may be classified as securities, subjecting them to stricter regulations, while others are viewed as commodities. This lack of clarity has created challenges for cryptocurrency projects and exchanges as they try to navigate a complex and evolving regulatory landscape. In China, the government has taken a much stricter approach, cracking down on cryptocurrency mining and banning financial institutions from offering services related to digital assets. Meanwhile, in India, the government has considered introducing a ban on cryptocurrencies, though this has been delayed several times. Regulatory uncertainty also complicates the adoption of cryptocurrencies by mainstream financial institutions and businesses. Many companies are hesitant to integrate cryptocurrency payments or invest in blockchain technology due to concerns about future regulatory changes or the potential for increased compliance costs. Despite these challenges, there have been positive developments in terms of regulatory progress. Some countries, including the European Union and the United States, are working on developing comprehensive frameworks to regulate cryptocurrencies, focusing on anti-money laundering, AML, and combating the financing of terrorism, CFT standards. These efforts aim to bring more legitimacy and stability to the industry, which could pave the way for greater institutional adoption. Fourth, lack of consumer protection. Another challenge in the cryptocurrency market is the lack of consumer protection. In traditional financial systems, regulatory bodies oversee exchanges and financial products to ensure that investors are treated fairly and that there are mechanisms in place for dispute resolution. In contrast, the cryptocurrency space is largely unregulated, which means that investors have limited recourse in case of fraud, scams, or market manipulation. The lack of consumer protection is particularly concerning for retail investors who may not fully understand the risks of investing in digital assets. The rapid rise of pump-and-dump schemes, where the price of a cryptocurrency is artificially inflated before being sold off by insiders, has raised concerns about market manipulation. Additionally, rug pulls, where developers abandon a project and steal funds from investors, have become more common, particularly in the DeFi space. While some exchanges and platforms have implemented measures to protect users, such as insurance funds and improved KYC procedures, the lack of overarching regulatory oversight leaves investors vulnerable to fraud and manipulation. 5. Environmental concerns. Finally, the environmental impact of cryptocurrencies, particularly Bitcoin, has been a growing concern. Bitcoin mining, which requires significant computational power, is known to consume vast amounts of energy. Critics argue that this energy consumption contributes to environmental degradation, particularly as mining operations rely on fossil fuels in regions with cheap electricity. In response to these concerns, some blockchain networks, such as Ethereum, are transitioning from energy-intensive proof-of-work (POW) consensus mechanisms to more energy-efficient proof-of-stake (POS) systems. These efforts aim to reduce the carbon footprint of blockchain networks and make them more sustainable in the long term. However, the environmental debate continues to be a challenge for the cryptocurrency industry, as the ecological impact of mining remains a key point of contention for regulators and the general public. The digital economy. How cryptocurrencies began affecting global financial markets and attracting investors. Cryptocurrencies have come a long way since the inception of Bitcoin in 2009. Initially viewed as a niche technology with little to no impact on global financial markets, digital currencies have grown into a massive global industry that continues to influence and transform the way we perceive and interact with money. The rise of cryptocurrencies has sparked significant changes in the digital economy, providing new avenues for investment and altering traditional financial systems. This transformation is ongoing, but it has already left a lasting mark on the financial world. 1. Emergence of cryptocurrencies and their initial impact. The cryptocurrency movement began with Bitcoin, the first decentralized digital currency, which was created by an anonymous entity or person known as Satoshi Nakamoto. Bitcoin was designed as a peer-to-peer electronic cash system, enabling individuals to send and receive payments without the need for intermediaries like banks or financial institutions. The idea behind Bitcoin was revolutionary: to create a currency that operated independently of central banks and was immune to government control. Bitcoin's early adoption was limited to a small group of technology enthusiasts, cryptographers, and libertarians who believed in the potential of decentralization and financial independence. The first major event in Bitcoin's rise to prominence was its use in a high-profile transaction. In 2010, a programmer named Laszlo Hanyecz famously paid 10,000 Bitcoins for 2 pizzas. At that time, the value of those Bitcoins was just a few dollars, but over the years, Bitcoin's value surged exponentially, leading to its widespread recognition and mainstream adoption. As Bitcoin gained traction, it inspired the development of numerous other digital currencies, known as altcoins. These coins aim to improve upon Bitcoin's technology, offer different features, or serve niche purposes within various industries. This explosion of new cryptocurrencies expanded the scope of the digital economy, creating a diverse market of digital assets with varying degrees of utility and market capitalization. 2. Increased investor interest and institutional adoption. As Bitcoin and other cryptocurrencies became more well-known, they started attracting the attention of investors, both individual and institutional. Initially, many people viewed cryptocurrencies as speculative investments with the potential for high returns but equally high risks. Bitcoin's meteoric rise in value, along with the growth of altcoins, made it an appealing investment opportunity for those willing to take on risk. The digital currency market was still in its early stages, and regulatory frameworks were largely non-existent or unclear. As a result, many retail investors entered the market through cryptocurrency exchanges that allowed for the easy buying and selling of digital assets. Platforms like Coinbase, Binance, and Kraken became popular for trading Bitcoin and altcoins, offering users a simple interface for investing in the market. Despite the lack of regulatory clarity, institutional investors began to take an interest in cryptocurrencies as well. In 2017, major hedge funds and family offices started to allocate a portion of their portfolios to digital assets, seeing the potential for long-term growth. Bitcoin's rise to over $20,000 in late 2017 was a defining moment, signaling to institutional investors that cryptocurrencies could no longer be dismissed as a passing trend. One of the major milestones in cryptocurrency's acceptance by institutional investors came in 2020 with the entry of financial giants like Grayscale and Fidelity. Grayscale's Bitcoin Trust, which allowed institutional investors to gain exposure to Bitcoin without directly buying the asset, became a popular investment vehicle. Similarly, Fidelity launched its digital assets division to provide custody services for institutional clients interested in cryptocurrency investments. 3. The development of DeFi and new financial ecosystems. While Bitcoin and Ethereum, another prominent cryptocurrency, focused on payments and decentralized finance, the rise of decentralized finance, DeFi platforms, has played a significant role in reshaping the digital economy. DeFi refers to financial services and products that are built on decentralized networks, primarily using blockchain technology, to offer services such as lending, borrowing, trading, and yield farming without intermediaries like banks. The introduction of DeFi platforms created a new way for investors to interact with cryptocurrencies. Instead of simply holding or trading digital assets, investors could now use their cryptocurrencies as collateral to borrow funds, earn interest on their holdings, or participate in liquidity pools to provide liquidity for decentralized exchanges. This opened up new revenue streams and opportunities for individuals and institutions alike. One of the key drivers of DeFi's popularity is the concept of smart contracts, which are self-executing contracts that automatically enforce the terms of an agreement. Built primarily on the Ethereum blockchain, smart contracts have enabled the development of decentralized applications, dApps, that allow users to engage in financial activities without relying on centralized authorities. In 2020, DeFi experienced an explosive growth phase, with the total value locked, TVL, in DeFi platforms skyrocketing from around $1 billion in January to over $80 billion by the end of the year. DeFi platforms offered investors the ability to earn high yields, often significantly higher than traditional banks could offer, making them an attractive alternative for yield-hungry investors. The rise of NFTs and broader market impact. Another significant development in the digital economy is the rise of non-fungible tokens, NFTs. NFTs are unique digital assets that are typically used to represent ownership or proof of authenticity for digital art, collectibles, and other items. Unlike cryptocurrencies, which are interchangeable with each other, NFTs are one of a kind, making them ideal for representing scarce digital goods. The NFT market saw a massive surge in 2021, with high-profile sales reaching millions of dollars. Artists, musicians, and creators began using NFTs to monetize their work, creating a new ecosystem for digital ownership and artistic expression. NFTs have also attracted mainstream attention, with major auction houses like Christie's and Sotheby's selling digital art pieces as NFTs. The rise of NFTs has contributed to the overall expansion of the digital economy, as it has attracted new users and investors to the cryptocurrency space. It has also opened the door for other types of tokenized assets, such as tokenized real estate and tokenized financial instruments, further expanding the utility and potential of blockchain technology. The influence of cryptocurrencies on traditional financial systems. The growing prominence of cryptocurrencies has begun to have a profound impact on traditional financial systems. Central banks and governments are increasingly exploring the use of digital currencies, including central bank digital currencies, CBDCs, to compete with or complement existing digital assets. CBDCs are digital versions of a country's fiat currency, issued and controlled by the central bank, and they have the potential to offer many of the same benefits as cryptocurrencies, such as faster payments and lower transaction costs. In addition to CBDCs, traditional financial institutions have started to incorporate blockchain and cryptocurrency technologies into their operations. Some banks now offer cryptocurrency trading services, while others are experimenting with blockchain for cross-border payments and other financial products. This growing interest from traditional financial institutions is a clear sign that cryptocurrencies are influencing the broader financial landscape. 6. Global regulatory environment. As the cryptocurrency market continues to grow, the regulatory landscape is evolving. Governments around the world are increasingly focused on establishing clear frameworks for the use and trading of digital assets. While some countries, such as Switzerland and Japan, have embraced cryptocurrencies and blockchain technology, Others, such as China, have imposed strict regulations or outright bans on cryptocurrency trading. In the United States, the Securities and Exchange Commission, SEC, has been active in determining which cryptocurrencies qualify as securities and which are classified as commodities. This regulatory clarity is crucial for the growth of the industry, as it provides a sense of security for investors and businesses operating within the space. The development of global regulations will play a significant role in shaping the future of cryptocurrencies and their integration into the broader financial system. Clear and consistent regulations will help foster trust in the market, encourage institutional investment, and ensure that cryptocurrencies are used in a manner that is transparent and secure. Continuous innovation. The future of cryptocurrencies in practical applications, such as decentralized finance, DeFi, and non-fungible tokens, NFTs. Cryptocurrencies and blockchain technology have come a long way since Bitcoin's inception in 2009. As the industry continues to evolve, the potential applications for digital assets are expanding, reaching beyond simple peer-to-peer payments to more complex and diverse areas of the global economy. Among the most exciting developments in the space are decentralized finance, or DeFi, and non-fungible tokens, NFTs, both of which represent the future of cryptocurrencies in practical, real-world applications. 1. Decentralized finance, DeFi. Redefining traditional financial systems. Decentralized finance, DeFi, is one of the most disruptive innovations in the cryptocurrency space, and it has gained massive attention over the past few years. DeFi refers to a set of financial services and applications built on decentralized networks, primarily on the Ethereum blockchain, which enables users to engage in activities such as lending, borrowing, trading, and yield farming without the need for traditional intermediaries like banks, brokers, or financial institutions. The primary advantage of DeFi is its ability to democratize access to financial services. In a world where billions of people remain unbanked or underbanked, DeFi platforms provide a crucial opportunity for financial inclusion. With DeFi, anyone with internet access can participate in the global financial system, without the need for a traditional bank account or intermediary. How DeFi works: DeFi platforms use smart contracts, self-executing contracts with predefined rules coded into the blockchain to automate financial transactions. For example, on a decentralized exchange, DX, users can trade assets directly with one another without needing a central authority to facilitate the exchange. DeFi applications also allow users to earn interest on their cryptocurrencies, engage in liquidity mining, and even take out collateralized loans. DeFi has grown exponentially, with the total value locked, TVL, in DeFi protocols reaching over $100 billion in 2021, a sharp increase from just $1 billion in 2020. The appeal of DeFi lies in its transparency, security, and the potential for high yields. For instance, yield farming allows users to provide liquidity to decentralized exchanges or lending protocols in exchange for interest and rewards. These rewards can often be much higher than those offered by traditional financial institutions. The future of DeFi. The future of DeFi is incredibly promising. As blockchain technology becomes more scalable and interoperable, DeFi protocols will expand to include a wider range of financial products and services. This could include decentralized insurance platforms, savings accounts, and even decentralized credit scoring systems, Zrania, which could allow individuals to build credit without relying on centralized credit agencies. Furthermore, the integration of Layer 2 solutions, such as Optimism and Arbitrum, will help address scalability issues, making DeFi applications faster and more cost-effective. The increasing involvement of institutional players in the DeFi space will also accelerate its mainstream adoption, leading to a more decentralized and open financial system. 2. Non-fungible tokens, NFTs, revolutionizing digital ownership and assetization. Non-fungible tokens, NFTs, are another groundbreaking application of blockchain technology. Unlike traditional cryptocurrencies such as Bitcoin or Ethereum, which are interchangeable with one another, NFTs represent unique digital assets. Each NFT is one of a kind and cannot be exchanged on a one-to-one basis, making them ideal for representing scarce or collectible items. NFTs have become especially popular in the realms of digital art, collectibles, gaming, and entertainment. Artists and creators can now tokenize their work, allowing them to sell digital art as unique, verifiable assets. The ownership of NFTs is recorded on the blockchain, ensuring that the provenance and authenticity of the digital asset are transparent and tamper-proof. NFTs and art and entertainment NFTs have significantly impacted the art world, allowing artists to directly monetize their digital creations without relying on intermediaries like galleries or auction houses. This democratization of art distribution has opened up new opportunities for digital artists and creators to connect with a global audience. High-profile NFT sales have made headlines, such as the $69 million sale of a digital artwork by Beeple, showcasing the immense potential of NFTs in the art world. In addition to art, NFTs have found use cases in the gaming and entertainment industries. Gamers can now purchase, trade, and sell in-game items as NFTs, creating a new economy around virtual goods. In some cases, these virtual assets can even be transferred between different games or platforms, providing players with greater ownership and control over their digital possessions. NFTs in real estate and other sectors. NFTs are also beginning to make waves outside of art and entertainment. In the real estate sector, for example, NFTs can represent ownership or a stake in physical properties. Tokenizing real estate enables fractional ownership, allowing individuals to invest in high-value properties without the need for a large initial capital outlay. This could potentially revolutionize the real estate market by making it more accessible to a wider range of investors. NFTs are also being used in industries like fashion, music, and sports to tokenize and authenticate products, royalties, and collectibles. This has led to an explosion of innovation as brands and creators experiment with new ways to use NFTs to engage their audiences and monetize their work. The future of NFTs. The future of NFTs is exciting and full of potential. As the technology matures, NFTs will continue to evolve and expand into new industries. The integration of NFTs with the metaverse, virtual worlds where users can interact, socialize, and create, will further enhance their utility. NFTs could serve as digital assets that represent land, property, avatars, or even unique experiences in the metaverse. Additionally, the emergence of more energy-efficient blockchains and Layer 2 solutions will address some of the environmental concerns associated with NFTs, making them more sustainable and eco-friendly. As NFTs become more mainstream, they will play a crucial role in reshaping the concept of ownership, allowing people to have verifiable digital assets that are easily tradable and transferable across platforms. 3. Continuous innovation in the evolving cryptocurrency ecosystem. Both DeFi and NFTs are examples of the continuous innovation occurring within the cryptocurrency and blockchain space. The potential for blockchain to disrupt traditional industries and create entirely new sectors is vast. Beyond DeFi and NFTs, the cryptocurrency ecosystem is also seeing innovations in areas such as decentralized autonomous organizations, DAOs, privacy-focused coins, and interoperable blockchains. Interoperability and cross-chain solutions. One of the key challenges that blockchain developers are addressing is interoperability, the ability for different blockchains to communicate with each other and share information seamlessly. Cross-chain solutions are emerging to solve this problem, allowing users to transfer assets between different blockchains and participate in multiple DeFi ecosystems simultaneously. For example, projects like Polkadot and Cosmos are working to create interconnected blockchain networks that allow for greater collaboration and data sharing. This could enable a more cohesive and scalable decentralized ecosystem,